So first things first, let's talk about the infrastructure package counterproposal and where it leaves us. The Republicans offering $928 billion. That's pretty much, a lot of money. Way higher than their first proposal. But what's important here is that they said they were willing to give even more. So it seems almost guaranteed at this point that a deal is going to be found. And it's probably going to be around the $1.3-ish trillion range. That's substantial. We're going to have all the bridges and tunnels, infrastructure, and some other things as well. We'll see how the final product comes, of course. But looks like this is going to be done. That means interest rates ticked up a little bit today. I'm not going to say with high conviction that they're correlated. But it means another 1.3-ish trillion of deficit spending is coming because the Republicans are still adamant that they don't want to increase taxes. I personally think this is the wrong time to increase taxes given the fantastic effect the previous tax cuts had. So we're really going to have to see what happens here. Regardless, we did see that tick in bond yields. And I do think that is a solid trend that should continue. I'm not going to say it's definitely going to continue because I've been, checked on that thesis, right? It hasn't been as strong as I would have predicted. It's not like I'm expecting a crazy move in rates, but, I would expect there to be a little more selling than there has been recently, given, relatively strong-ish economic outlooks, travel spending data, these kinds of things. But with, another $1 trillion, who's got $1 trillion to put into things and spend? The Federal Reserve. So, we will have to see. But I expect rates to slightly tick up. Now, some growth did have a really good day today. You look at stuff like Virgin Galactic, other space stocks, GSAT, they were up pretty nicely. Even with this interest rate hike. And, it goes back to our thesis on how we're going to invest in growth, or have been over here, and how we suggest you do going forward if you haven't been already. Anything that, is like a headline name, something like that, a SPAC, don't use that as your thesis to buy, right? Because that probably is a pretty expensive stock already. Look for stuff that is something you perceive. Start with the first order thinking. Perceive what you think is going to have a big effect on the future. Then go out and see if there's a stock that's doing that. Research, make sure it's the right stock, good company, good management, all that, good earnings calls. You can really get a lot of information there and insights on how they're thinking. Then look at the price. Is the price reasonable for the impact the technology will have? If so, does it have the possibility to 5 or 10x from its current valuation? And if that is the case, you can buy it and hold and not worry about this interest rate stuff, because as long as they're going to continue growing, and I've been saying this and have believed this for some time, but the social capital Chamath Palihapitiya video letter that dropped yesterday really put it in words, this notion I was trying to describe. If a growth company can grow, substantially faster than the rate of inflation and the rate increase in interest rates, any sort of sell-off due to interest rates is really just a short-term buying opportunity. So look for companies that you think can 5 or 10x, because they can 5 or 10x. And interest rates can't 5 or 10x. It's highly unlikely that the dollar 5 or 10x is we'll have way bigger problems on our hands if that happens. So anyways, that's how we're playing the tech trade. Infrastructure, back to this for a second. This is going to mean a lot for energy consumption. In addition, we're seeing the chip shortage seem to alleviate. Anecdotally, I've seen the BMW dealerships start to fill up. And dealership lots have been a serious problem as of late. Excuse me. And GM said they're going to bring 5 factories back online. So that, combined with infrastructure spending, could be a good thing for energy prices. Now, we haven't seen any production cuts yet, or production increases yet, but that doesn't mean they're not going to happen. So we'll have to keep our close eye on that. that happens, I'm ready to start exiting the trade everywhere except ExxonMobil. Except ExxonMobil. Porsche deal if you want some more info and insights on why. And, other than that, I'm just looking for good prices. Right now, it's really just a good price market. You can outperform. I have outperformed significantly the past couple days, not because I'm so heavily weighted on a single trend. I have some energy, I have some growth, I have some other stuff. I just have the right stuff. I have well-priced stuff. And everything is going to start, people are going to start looking to put money in stocks if they haven't already, and that's likely that's going to continue to be the case. People are going to continue to want stocks, but always in an environment like this, it seems to me that the best price stocks, obviously the best price stocks should do well, but the best price stocks relative to what they do, relative to earnings, relative to competitors, stuff like Intel. I think Intel is a good example of what I'm trying to articulate here. They might not have the most growth potential, but they're very well priced for what they do in an incredibly important product. And over the next 5 to 10 years, I think will be one of the best performing relatively large cap stocks from this point, from this day. Mark the day. So that's how I'm playing things. That's how I'm positioning. And until next time, peace out.